Hi there, welcome to Grain TV. I'm Kevin McNew. It's Tuesday, April 5th, and today saw another mixed day in grains. Let's take a look at the grain hedge trading platform and see where we closed. In Chicago, corn managed a positive day after Thursday's USDA crop report that showed higher acres, gaining today 2 1/4 cents a bushel. Soybeans was the leader to the downside, losing 8 3/4 cents, while wheat managed to close just fractionally lower, losing 3/4 of a cent. News today was pretty light. We did have palm oil breaking down in Malaysia overnight after being up sharply the last 3 days and continuing a sort of long-term uptrend as a result of the El Nino problems that have led to crop problems in that part of the world. Also, after the close today, we got new crop forecasts from Brazil. Solari's private consultant said that they expected the Brazil soybean crop to be 99.9 million metric tons, up from their previous forecast of 99.1, and likewise corn was also higher in their forecast, going to 87.5 versus 87.1. Also today we will get later this afternoon USDA's first crop progress or crop condition scores for wheat. Most analysts are looking for a pretty good number coming in at average analyst expectations of 57.6%, good to excellent. That would be up from last year and up from the 5-year average as well. But in terms of wheat, even though we have substantially lower acres going into the 2016 crop year, off 5 million from last year, we still have the ongoing struggle of being competitive in the world market. It's something we've talked about, other analysts have talked about. The U.S. continues to be fairly high priced in comparison to our foreign competition. And in particular, let's take a look at where the U.S. stands in relation to France. In this chart, we have the U.S. in orange and France in purple. This is a 5-year chart, so it shows real long-term trends. And what we're looking for here is sort of the spread. Who's the higher cost country versus the other? And if we go back to 2014, that was sort of before we got into this period of exceptionally strong U.S. dollar. The U.S. dollar was trading at about 0.75 euros, and at that time the U.S. and France were trading around the same price for wheat. But jump forward in 2015 when the euro economy started to really struggle with Greece and Spain, and the euro as a general rule of thumb became weaker and our dollar became stronger. The U.S. dollar advanced to 0.95 euros at its peak back in January, and at that time and throughout much of the previous 2015 marketing year, our wheat has been trading at a $35 a metric ton premium over French wheat. Now, even with the weakness in the dollar that we've seen, the US dollar index falling about 6% since its high at the start of the year, we are not seeing a substantial revision in that spread. Today, that spread between the U.S. and France still stands at a hefty $32 metric ton premium for the U.S. So that, in my opinion, is what's going to need to change before we can start to see the wheat market get any sort of real upside potential, because without exports, our ending stocks will continue to balloon even with this sharp drop in acreage. So that's a lingering problem that the wheat market's going to face unless we have substantial crop problems. Other things I want to talk about today, I want to talk about trading techniques, and in particular I want to focus on something that's exclusive in the grain hedge trading platform, and that's what's called a trailing stop. Now, most of you may be familiar with a traditional stop where you use a stop to protect profits or limit your losses. It's a price you set that if the market gets to that point, your position will be liquidated. And that stop, the traditional stop, is usually fixed, and unless you manually move the stop around, it's going to stay fixed. The nice thing about a trailing stop, again in our grain hedge trading platform, is that trailing stop will actually move in conjunction with the market. And I want to show you an example of how this could work in your own trading strategy. And let's take a look at maize soybeans. This is an hourly chart, but we've had a big slide here. And those of you who are watching our technical alerts know that starting on Monday we were predicting that slide to happen. And so if you went short today, let's say around 9/11, then you might try and set a trailing stop. And let's say you set the stop price up at this most recent high of 916. Now, the only other thing you need to set when you set a trailing stop is what's called the delta. The delta is the point move that the market needs to move so your trailing stop will move in accordance. So if I set a delta of 1 cent or 0.01 in the platform and my initial stop price is 916, that means that every penny that the market moves down, my stop will also move down by a penny as well. So if we set that stop in real time during trading when the market was 911 and we initiated that short position, initially our stop was 916, but by the end of the day we got down to a low. The low in the market was 904. So our stop has followed us all the way down and currently rests at 909, that 5 cent differential between where I set it and where the market was at the time. So the beauty of that trailing stop is it's going to move in conjunction with the market. As the market falls, in this case, if you're short, then it's going to move your stop down and help further protect your profits or lock in additional profits as the market moves. It's a very valuable tool. And again, if you're not a trading client, you want to see that in action and try our trading platform, visit us online at grainhedge.com to take a free, no obligation trial of our trading platform. That's all we got for today on Grain TV. Join us tomorrow. We'll talk about what USDA said in their crop condition scores. GrainHedge is pleased to announce a new tool called Technical Alerts. Technical Alerts is free to our trading clients and delivered by email first thing in the morning every trading day. Technical Alerts is a powerful, easy-to-use system that provides quality trading opportunities. Each trading opportunity shows a chart and analysis, providing clear price targets and risk potential to allow you to make an educated trading decision. The commodities covered include grains, livestock, crude oil, currencies, bonds, and metals. Technical Alerts look at historical chart formations and compare the current environment to the past to form concrete trading recommendations. Let's take a look at how to interpret a technical alert. At the top, you will see a red or green indicator arrow which signifies the market's likely move. Red shows when weaker prices are expected, and green for when higher prices are expected. The summary section shows the expected price target and the expected duration it should take to reach the target. Also, Technical Alerts provides both support and resistance to help you identify key levels on the price chart. Underlying support is where technicians believe there is a level of buying interest, while overhead resistance is the price level thought to trigger more active selling. The support is marked with the letter A on the corresponding price chart, and resistance is marked with the letter B. Below the chart, you will see the data interval of the bars. For example, a 1-hour data interval means the chart pattern was constructed from a 1-hour bar chart. And when you are using the GrainHedge trading platform, you can use the pull down on your chart to change the bar interval to the appropriate time period. As always, we strive to provide you the best tools to improve your trading and hedging activity. If you have any questions on how to use Technical Alerts, please contact us at 877-472-4607 or by email at support@grainhedge.com.